In this lesson, we'll show you the basic strategy for trading in a sideways trend. The big question is, where is the price going to turn? In an uptrend, the tendency is for the price to turn up somewhere above the controlling swing low. In a downtrend, the price should turn down somewhere below the controlling swing high. So what we take away from all of this is that we must anchor our entry points off of the lows and highs, respective of the trend direction, whether the trend is up or down. But what about a sideways trend? In a sideways trend, we see the market contained within a range as price oscillates back and forth between the highs and lows. When you identify this type of price action, we look to sell at supply near the highs of the range, and we look to buy at demand zones near the lows of the range. Typically, the segments in a sideways range are relatively equal in height. With that in mind, once we've identified a sideways trend, we want to look for supply zones at the high end of the major down segments. We also want to look for demand zones at the low end of the major up segments. One thing that is particularly important in a sideways trend is how wide the range is. Now, the reason being is that profit potential for trades in a sideways trend will be the boundaries of the range. Therefore, we must set the expectation for profitability accordingly. If the range is too narrow, the profit potential is too small, and it may be better to wait for price to break out of the range before joining the market. However, if the range is wider, then there may likely be sufficient profit potential when trading at the extremes. So now you know the basic strategy for trading in a sideways trend. First, we confirm the trend, and then we look for supply zones near the highs and quality demand zones near the lows. In simple terms, within a range, we always trade the extremes. We'll get into more details regarding time frames later down the line, but as a general rule, the entry zone should be located on an equal or lower time frame than the time frame used for trend analysis. Now, we can expect to find the lowest risk zones by looking 3 to 4 time frames lower than our trend time frame. Now, let's look at an example. Now, if you look at this chart here on the bottom left, we've identified an uptrend on a 60-minute chart. To identify an entry zone, we take our chart down to 15-minute candles. Notice the qualified demand zone, which has good zone structure. It's located within the breakout segment of the uptrend. It's located above the most recent low and below the most recent swing high. When price comes back to this demand zone, we see price turn at the zone and rally out, continuing the uptrend. This will wrap up the strategy for each trend: uptrends, downtrends, and sideways trends. Drawing segment boxes will assist with painting a clear picture of what price is doing and help define controlling swing highs and lows. This visual helps us identify the breakout segment of the uptrend and the downtrend. And of course, with the sideways trends, there are no breakout segments. As you may have figured out by now, having a process is critical when trading. Following these simple steps will create good routines, healthy trading habits, and discipline, which will carry you throughout your trading career. Now that you know how to classify trends, our next step will be scoring trend as an odds enhancer. Before you move on, go back to any previous sideways trends you've identified and practice locating the major swing highs and lows of the range. Look to buy at the low end of the range and look to sell at the high end of the range. Hope to see you in the next video.